How does a company print its best revenue growth in 15 years, generate $7 billion in pure operating cash flow, and somehow still report an $11 billion net loss?
Yeah, that is the exact question everyone is asking right now.
Right. So Intel just printed Q2 2026, and I mean, it is a definitive beat across the board. The narrative coming into this print was extremely cautious, but the numbers explicitly exceeded financial guidance on really robust demand.
Absolutely. The top line revenue came in at 16.1 billion. That is up a massive 25% year over year.
And on the bottom line, if you strip out the noise that we're going to dissect in just a minute, we're looking at a non-GAAP EPS of 42 cents.
Which completely blows past street expectations,
Mm.
especially when you consider they were staring down, a loss of 10 cents in this exact same quarter just a year ago.
Right, exactly. And the forward-looking guidance is setting a very aggressive pace. Q3 2026 revenue is projected at 15.8 to 16.8 billion with a non-GAAP EPS of 38 cents, and non-GAAP gross margins are holding strong at 42.0%.
Yeah, and, while the static print release obviously doesn't capture the live after-hours stock ticker reaction, I mean, watching the tape right now, these fundamental numbers represent a definitive structural beat.
Completely. But jumping straight into how they actually achieved this beat, you really have to look directly at the mechanics on the factory floor.
Yeah, CFO Dave Zinsner was pretty clear. He explicitly cited volume upside driven by two crucial operational factors: higher factory yields and improved cycle times.
Which, for anyone modeling semiconductor manufacturing, I mean, those are the absolute twin engines of profitability.
Oh, without a doubt.
But let's actually explain the mechanism there for a second, because improved cycle times don't just mean a manager yelled at the floor to work faster.
No, it is a highly technical metric. Cycle time is the total duration it takes for a bare silicon wafer to go through the, hundreds of complex chemical and optical steps required to become a finished processor.
Right.
So when you improve cycle times, wafers are moving through the fab faster. Financially, this reduces your work-in-progress inventory, which frees up working capital.
And crucially, it maximizes asset utilization.
Exactly. You are getting more sellable product out of the same multi-billion-dollar lithography machines in the exact same 90-day quarter.
And then you pair that with higher factory yields. Yield is simply the percentage of functional chips you get off a single silicon wafer.
Right, the good chips.
Yeah. If a wafer costs $15,000 to process and you get 500 good chips instead of 400 because your defect rate dropped, your cost per unit just plummets.
It drops aggressively. When you combine those faster cycle times with higher yields, you get a massive compounding effect on gross margins.
I mean, that operational leverage is exactly how you drive a 25% top-line increase all the way down to a 42-cent EPS.
It really is the purest form of operational leverage in this industry. But, as analysts, seeing the top line grow 25% is only step one.
Right, we have to look under the hood.
We need to dissect exactly which business units actually drove that 16.1 billion. And more importantly, we have to evaluate if that momentum is structurally sustainable or if it's just a temporary pull forward in demand.
Yeah, and the divergence in the segment revenues is what tells the real story here.
Right. So DCI Data Center and AI is the obvious heavyweight this quarter. They posted 6.3 billion.
Which is an explosive 59% increase year over year.
Yeah, massive. It proves the heavy enterprise compute demand is finally materializing on Intel's balance sheet, not just on their competitors.
Right. But then we look at the client side. So CCPG came in at 8.9 billion, which is up 13%. And honestly, this is where I have to push back a bit on management's narrative.
You're looking at the rebranding, aren't you?
Absolutely, I am. They renamed the Legacy Client Computing Group to the Client Computing and Physical AI Group.
Yeah, the physical AI part.
I mean, to me, slapping physical AI onto the old PC and laptop division feels exactly like marketing putting lipstick on a pig. It just looks like a blatant attempt to catch the AI valuation multiple on what is fundamentally a mature, slow-growth PC market. Where is the actual booked revenue proving this isn't just an exercise in AI washing?
So it is the right instinct to be skeptical of any AI rebrand in this market right now. But if you dig into the facts from the release, there is real shipped silicon behind this.
Okay, but how much?
Well, Intel isn't just trying to sell you a more expensive laptop chip here. This is a strategic pivot toward actual physical world applications, meaning robotics, autonomous edge devices, and industrial automation.
Sure, but the release says they have 130 customers testing a chip. Testing does not equal a sustainable revenue run rate. Until those edge AI frameworks actually translate to top-line growth, it still feels, highly speculative.
I get that, but testing precedes volume production. They have over 130 enterprise customers actively integrating their Core Ultra Series 3 and Core Series 3 processors specifically for edge AI. And it's not just the hardware. They are pushing frameworks like OpenVINO Physical AI to help developers deploy robotics models for vision, language, and motion control workloads directly on local hardware.
So they want to be the default local compute.
Exactly. They are positioning these specific chips as the local compute engines for autonomous systems, where latency is simply too critical to send data all the way back to the cloud.
Okay, fair point. If they are successfully making that hardware the default standard for industrial robotics, that does represent a fundamental expansion of their total addressable market. It moves them away from just legacy consumer PCs.
Right.
But let's look at where the massive capital is flowing right now, Intel Foundry.
Yeah, Intel Foundry reported $5.8 billion in revenue, up 31% year over year.
Which sounds phenomenal for their turnaround narrative. I mean, until you look at the accounting adjustments, you have to subtract the massive $5.5 billion in intersegment eliminations.
Yeah, that's the catch.
And just for the retail investors tracking this, intersegment elimination basically means Intel's internal product groups like DCAI and CCPG are effectively paying Intel Foundry to make their chips.
Right. It is literally moving money from the left pocket to the right pocket.
Mechanically, it tells you that the foundry is still almost exclusively reliant on Intel's own product groups. The external foundry business, manufacturing chips for third-party fabless designers, is still in its absolute infancy.
Yeah, it's a rounding error right now.
Yeah.
The foundry is scaling its capabilities, definitely, but it doesn't have the third-party customer base to validate it as an independent profit center yet.
Exactly. Oh, and just to briefly round out the segment data, the all other segment dropped 33% to $0.7 billion.
Yeah, but don't let that spook your models.
Right.
That drop is entirely a mechanical accounting adjustment. It's just due to the deconsolidation of Altera rolling off the books back in late 2025. It has zero impact on core operations.
Right. Good to know. But speaking of accounting adjustments, we have to talk about the most glaring contradiction in this entire report.
The GAAP numbers.
Yes. This is something you need to understand deeply to evaluate this equity. We have to unpack this $11.0 billion GAAP illusion.
And this right here is exactly why reading the footnotes of an earnings release is non-negotiable.
Exactly. So let's lay out the margin recovery first. Non-GAAP gross margin hit 41.8%. That is up 12.1 percentage points year over year.
Which is wild.
In semiconductor manufacturing, a 1,200 basis point margin expansion in 12 months is a massive, almost unprecedented operational turnaround. I mean, they generated $7.0 billion in cash from operations in a single 90-day quarter.
Right.
But then you scroll down to the bottom line, and they reported a GAAP net loss of $11.0 billion. That translates to a $2.16 EPS loss on a GAAP basis.
Yeah.
So, to repeat the question we opened the whole deep dive with, how does a company print 25% revenue growth, generate $7 billion in operating cash flow, but report an $11 billion GAAP net loss?
It comes down entirely to a $12.5 billion non-operating charge buried in the interest and other net line of the income statement. What we are looking at here is a mark-to-market loss on, quote, escrowed shares.
Right, so let's untangle that math for the listener, because mark-to-market loss on escrowed shares sounds like, I don't know, engineered financial jargon designed to hide something terrible.
I know, it sounds awful, but it's actually just a quirk of the CHIPS Act.
Yeah.
So as part of the U.S. Department of Commerce Secure Enclave Agreement, Intel was required to place shares of its common stock into an escrow account.
Okay.
These shares are scheduled to be released to the U.S. government over time, right? Basically, as Intel hits performance milestones and receives the actual cash proceeds from the CHIPS Act grants.
Okay, so the government is getting equity as they give out the cash.
Exactly. And under standard generally accepted accounting principles, or GAAP, these escrowed shares have to be treated as a derivative liability on Intel's balance sheet.
Let me give you an analogy to make this crystal clear. Imagine you buy a house using a specialized government loan. But the condition of the loan is that the government gets a percentage cut of the property's value.
Right.
If your neighborhood suddenly becomes highly desirable and your house doubles in value, you technically owe the government much more money on paper.
Yes.
Your bank account is full of cash from renting the property out, and your day-to-day operations are thriving, but your personal balance sheet looks terrible because the asset got too valuable.
That is precisely the mechanism at play here. As the value of Intel stock increases in the open market, The dollar value of the liability of those escrowed shares also increases.
Ah.
So this quarter, because the stock performed well, they had to recognize a massive mark-to-market loss on those shares to reflect their new higher value.
So if you are looking at the Gap print today, do not panic. This is not cash going out the door.
No.
It is not a bloated operating expense or a massive legal settlement or a write-down on debt inventory. It is essentially a paper loss on a volatile government equity derivative.
It's exactly
If the stock goes up, the liability goes up, and Gap requires them to record that as a loss, even though their fundamental operations are literally minting cash.
Which means if you want to understand the actual operational health of the business, you have to look at the non-GAAP net income. And on a non-GAAP basis, net income was a positive $2.2 billion.
Huge difference.
Right. That $2.2 billion is the number that reflects the actual cash-generating power of the data center and client segments we just discussed, completely stripped of this complex government equity structure.
Okay, so having cleared up that balance sheet noise, let's shift to management's forward-looking strategy. We have this incredible momentum. We have the $2.2 billion in real non-GAAP net income. But where are they allocating capital to maintain this trajectory?
Well, management was incredibly vocal this quarter. We had CEO Lip-Bu Tan stating that this Q2 represents Intel's strongest revenue growth in more than 15 years.
Yeah.
And he explicitly credited, quote, unprecedented demand for compute.
And to feed that compute demand, CFO Dave Zinsner made it clear that they are meaningfully increasing capital expenditure. They are directing that CapEx specifically into fab equipment, advanced cleanroom space, and advanced packaging substrates for this year and next.
Yeah, in an environment where some competitors are getting cautious, Intel is leaning heavily into the capital cycle.
Which they have to. In semiconductors, CapEx is destiny. You simply cannot fake manufacturing capacity. So let's get specific on where that CapEx is actually going.
Okay.
They highlighted the launch of the Xeon 6 Plus server product. And what is critical for your models here is that this is their first major server-class product built entirely on the highly anticipated Intel 18A node.
Right. And the Intel 18A node is the absolute linchpin of their entire IDM 2.0 turnaround strategy.
Yeah, make or break.
Exactly. Getting a complex, high-core count server CPU like Xeon 6 Plus yielding on 18A proves to the market, and obviously to potential external foundry customers, that Intel can achieve sustained performance and acceptable thermals on their most advanced manufacturing process.
But they aren't stopping at 18A. The CapEx is also heavily funding the high-volume manufacturing ramp of their next-generation client processors, codenamed Panther Lake.
Yeah.
And what you really need to note is that Panther Lake is using ASML's cutting-edge high-NA EUV technology.
And we definitely need to explain why high-NA EUV matters for their margins, because it is not just a shiny new toy.
No, it's critical.
So EUV stands for Extreme Ultraviolet Lithography, and high-NA means high numerical aperture. Without getting bogged down in optics physics, a higher numerical aperture essentially allows the machine to capture a wider angle of light.
Right.
And this lets Intel print significantly finer and denser silicon features, meaning the actual microscopic wiring of the chip, in a single exposure.
Right, because previously, to get features that small manufacturers had to use multi-patterning, meaning running the same wafer through the machine 2 or 3 times to slowly build up those complex patterns. And multi-patterning drastically increases the time a wafer spends in the fab. Plus, every single time you put a wafer through a machine, you introduce a mathematical probability for alignment errors and defects.
Yes, the defect rate climbs.
So by using high-NA EUV for single exposures, Intel slashes cycle time and drastically reduces defect rates, which translates directly back to those higher factory yields and the 42% gross margins we talked about in the open.
It is a massive execution milestone.
Yeah.
I mean, they are fully utilizing the most expensive, most advanced lithography machines on the planet for high-volume manufacturing.
Yeah.
But, you know, their capacity expansion isn't just focused on the bleeding edge in the U.S. They also announced a €5 billion investment to expand manufacturing capacity in Europe.
Right.
But notably, that European capacity is specifically designed to increase production of the Xeon 6 and next-generation processors built on the older, more proven Intel 3 node.
Which shows a very specific bifurcated CapEx deployment strategy.
Yeah, it does.
I mean, assuming they can actually get the ASML machines delivered and running on schedule, they are pushing the absolute bleeding edge with 18A and high-NA EUV in their U.S. fabs, while simultaneously spending €5 billion to aggressively scale volume on the proven Intel 3 node in Europe.
It's a very pragmatic approach to capital allocation. Scaling the Intel 3 node in Europe solves their immediate capacity issue for current data center demand, and it addresses European data sovereignty concerns.
While the U.S. fabs focus on winning the technology leadership crown back.
Exactly.
But of course, that strategy requires absolutely flawless execution, which naturally brings us to the risk assessment. No serious analyst recap is complete without stressing the downside scenarios.
Never.
We've talked a lot about the bullish CapEx investments, but what are the macro and micro threats that could, derail this 42% gross margin guidance over the next 12 to 18 months?
Well, if you dive deeply into the safe harbor forward-looking statements at the bottom of the release, there is a very heavy, unmistakable emphasis on geopolitical tensions.
Always is, but especially now.
Right. The language specifically highlights international trade policies, tariffs, and export controls. They impartially list out the major macro pressure points. You've got trade tensions between the U.S. and China, the ever-present tensions between mainland China and Taiwan, and conflicts affecting supply chains in the Middle East and Ukraine.
And the specific risk there isn't just supply chain disruption, right? It is regulatory demand destruction.
Exactly.
If a new round of strict U.S. export controls on advanced AI silicon is enacted, it could immediately sever Intel's ability to ship their highest margin DCAI processors to key global markets.
And that instantly vaporizes a huge chunk of their total addressable market.
Right. But we also have to look at the domestic side of the geopolitical equation, because the very thing propping up a massive portion of Intel's capital expenditure, the THE Act, comes with heavy strings attached.
Yeah, as we saw with the $11 billion gap illusion, the U.S. government now holds significant equity interests in the company via these escrowed shares.
That creates entirely unique complexities and potential dilution risks for you as a retail investor. You are now essentially co-invested alongside the Department of Commerce and the Department of Defense.
Right.
And you have to assume that the U.S. government's strategic priorities regarding domestic national security and supply chain resilience might not always perfectly align with your priorities for quarterly shareholder returns and stock buybacks.
Yeah, not at all.
If the government wants Intel to keep a domestic fab running for strategic reasons, even if it operates at a loss, that impacts your bottom line.
It introduces a totally non-market variable into their operational strategy.
Yeah.
And this raises an important question about their internal execution risks, too.
Yeah.
Beyond the macro environment, there are inherent company-specific execution risks. Intel is essentially betting the farm on ramping up the 14A and 18A nodes flawlessly. We discussed how higher yields drove the gross margin beat this quarter. If they stumble on the transition to high-NA EUV, or if the yields on 18A drop as they attempt to scale from test wafers to high-volume manufacturing, those expanded 41.8% gross margins will vanish instantly.
Oof.
Gone. Semiconductor manufacturing is ruthlessly unforgiving. One stubborn flaw in a new process node can wipe out a year's worth of operating profit.
So true. Okay, let's step back from the immediate quarter for a second and look at the ultimate trajectory of the company. We want to leave you with a high-level strategic question drawn from a very subtle detail buried deep in the business highlights of this report.
Yeah, this is interesting.
Throughout the release, Intel keeps repeatedly mentioning agentic AI infrastructure.
Yes.
Yeah.
And this is a critical evolution of their business model. They aren't just selling standalone chips to server OEMs anymore.
Yeah.
The report explicitly highlights that they collaborated directly with Samanova and Foxconn on, quote, production-ready rack-scale AI infrastructure. They are actively working on disaggregated agentic clouds combining Intel Xeon processors, Samanova RDUs, and NVIDIA GPUs, all in one integrated system.
And for context, an agentic cloud isn't just a server that runs a language model to answer a question.
Right.
Agentic AI refers to autonomous AI agents that can break down complex goals, write their own code, interact with different software, and execute multi-step workflows entirely without human intervention.
And that requires a completely different network architecture than a standard database server.
Right. It requires immense compute density and lightning-fast interconnects at the rack level, not just the individual chip level.
Which is exactly why Intel is co-designing the entire rack.
So here is the provocative thought we want to leave you with as you update your models today. If Intel is moving beyond just supplying raw silicon components to actually designing and demonstrating full rack-scale AI systems, are they preparing to compete directly with system builders and cloud providers?
It's a huge question.
As they integrate CPUs, AI accelerators, and advanced packaging at the total rack level, Are we witnessing Intel transition from being a legacy component supplier to becoming a full AI infrastructure architect?
Right, because if they can successfully sell fully integrated agentic racks directly to data centers, they capture the margin that usually goes to a Dell or an HP.
Exactly. And if they pull that off, their long-term valuation multiple changes entirely.
It fundamentally redefines their place in the value chain. They basically stop being just the brickmaker, and they become the architect.
Keep a close eye on these gross margins going into next quarter, and make sure to follow the show for our daily earnings coverage. See you tomorrow.